Okay, so you want to own a construction company. Skyscrapers with your name on the permit. Multi-million-dollar contracts. Bulldozers rolling in at sunrise. Buildings rising by winter. It feels like real wealth. Physical, permanent, undeniable, the opposite of some app on a phone. But here's the strange part. The average general contractor in the United States keeps somewhere between 5 and 6 cents of every single dollar that passes through the business. Not 50 cents. Not 20. 6. And even that thin sliver isn't guaranteed. It's the number left over after you've already survived the part of the industry that kills more companies, faster, than almost any other sector in the American economy. You can win a $100 million contract, run the crews well, pour the concrete on schedule, and still go bankrupt finishing it. That's not a hypothetical. That's the entire business model. So let's build the thing properly, from the ground up, and find out where the money actually goes. Here's how you get work in the first place. You bid. Someone puts a project out to tender, a hospital wing, an office tower, a housing development, and every contractor in the region throws a number at it. Lowest qualified bid usually wins. That single fact shapes everything else about this business, so sit with it for a second. You are not setting your price. The market is setting it for you, downward every single time, because there's always another contractor hungry enough to shave another point off their margin just to keep the crews working. Here's the part that breaks people's brains coming into this industry. Markup and profit are not the same number, and confusing them is how contractors go broke while believing they're profitable. Markup is what you add on top of your direct job costs, materials, labor, equipment, to cover your overhead and leave something behind. In 2026, that markup typically runs between 12 and 30% depending on the trade and the region. Sounds healthy, but overhead alone, insurance, project management software, office staff, licensing, safety compliance, now eats 10 to 15% of revenue before you've paid yourself a single dollar of profit. Strip that out of a 20% markup and you're left with a net margin most years of somewhere between 5 and 10%. Best-in-class operators, the ones with real estimating discipline and purchasing leverage, push into the 10 to 12% range. Most don't get there. The industry average net profit margin sits at around 5 to 6%, thinner than retail, thinner than restaurants, thinner than almost anything else you could put your capital into. And that's before the second problem shows up. Materials don't wait for your margin to recover. Tariffs on steel and aluminum have pushed the effective rate on construction goods to a 40-year high, somewhere in the 25 to 30% range, with steel up around 13% and aluminum up around 23% on top of already elevated post-pandemic pricing. Skilled labor is scarcer too. The overwhelming majority of construction firms report difficulty finding workers, and fieldcraft wages are running at an 18% premium over typical private sector pay just to keep crews on site. You bid a job today based on today's steel price. You deliver it 18 months from now at whatever the steel price has become. The gap between those two numbers is not the client's problem. It's yours. The math always wins eventually. And in construction, the math is designed to win slowly, quietly, on a project you already thought you'd priced correctly. There's a second trap sitting right next to the bidding one, and it's the reason so many contractors quietly resent their own clients. Change orders. A change order sounds simple. The client wants a different finish, a moved wall, an upgraded system, so you charge them for the extra work. In theory, this is where contractors actually make real money, because change order work isn't subject to the same brutal competitive bidding as the original contract. In practice, it's a constant fight. Clients dispute the scope. Clients delay approval until after the work is already done, because delaying approval costs them nothing and costs you financing. And on public contracts especially, a change order can sit unapproved for months while you've already paid for the labor and the materials that delivered it. You did the work. You're owed the money. You're also, once again, financing someone else's decision with your own cash. Now here's the part that actually kills companies, and it isn't the thin margin. Plenty of low-margin businesses survive for decades. What kills construction companies is cash flow, and cash flow in this industry is structured against you from day one. Think about the order of operations. You buy the steel, you pay the crew, you rent the crane. All of that happens now, this week, this month. The client pays you later, often 30, 60, 90 days after you've already spent the money, sometimes longer on large public contracts. You are, functionally, financing your client's building with your own working capital, and you're doing it on a margin of 5 to 6 cents on the dollar. Then there's retainage. On most contracts, the client withholds a percentage of every single payment, typically 5 to 10%, and holds onto it until the entire project reaches practical completion, sometimes not releasing the final half until the defect's liability period closes months after that. So even the money you did earn isn't fully in your hands until long after the crews have gone home and moved on to the next job. You're not just underpaid in the moment. You're underpaid on a delay, on a project you've already fully staffed and fully paid for. Here's what nobody tells you going in. You can be profitable on paper and dead in the bank account at the same time. Those are two completely different tests, and construction is one of the only industries where a company can fail both simultaneously, reporting a profit in its annual accounts while running out of actual cash to make payroll the same quarter. Anyway, if you're finding this rebuild the fantasy from scratch approach useful, this channel does one of these a month, a different asset, the same forensic breakdown. Hit subscribe so the next one lands in front of you. So what happens when a company built exactly like this stops managing the gap? You get Carillion. Carillion was Britain's second largest construction and support services company, employing around 43,000 people, with contracts running everything from hospitals to motorways to school maintenance. On paper, right up until the summer of 2017, it looked healthy. Then, in July that year, it announced a hit to profits of £845 million. Its chief executive resigned, and its share price lost 70% of its value in 2 trading days. 6 months later, in January 2018, Carillion collapsed into compulsory liquidation with debts of over £1 billion, total liabilities close to £7 billion, a pension deficit north of £500 million, and just £29 million left in the bank. Here's the mechanism, and it's the same one we just built from scratch, just at a much larger scale. Carillion had taken on enormous long-term contracts, many on thin margins, with extended payment terms from clients. To bridge the resulting cash gap, the company leaned on something called an early payment facility, a scheme where suppliers could get paid early by a partner bank in exchange for a fee, while Carillion then owed the debt to the bank instead of the supplier. It's a clever trick, right up until it isn't. That liability didn't show up clearly on the balance sheet, even as it grew to somewhere between 250 and 300 million pounds. Suppliers were also made to wait more than 120 days for payment as standard practice. Meanwhile, between 2009 and 2017, the company's debt rose by roughly 300%, while the value of its long-term assets grew by only around 14%. And through all of it, the board kept paying dividends and executive bonuses, which, under the logic of dividend signaling, is supposed to reassure investors that everything is fine. It reassured them right up until there was £29 million left to reassure anyone with. Carillion didn't die because it stopped winning contracts. It died because it had turned cash flow management into a permanent, structural bluff, and eventually there was no more supplier, bank, or government department left willing to extend the bluff another quarter. And here's the detail that should genuinely unsettle you if you're thinking about this as an investor rather than an operator. The UK government kept awarding Carillion new contracts almost right up to the collapse. Winning work was never the problem. The company that went bankrupt owing close to £7 billion was, at the exact same time, one of the most in-demand contractors in the country. That's how disconnected, busy, and solvent can become in this industry. A packed order book isn't evidence of a healthy company. Sometimes it's evidence of the opposite. A company so desperate for fresh cash to plug yesterday's hole that it keeps bidding on tomorrow's job at a margin too thin to ever dig itself out. The building isn't really the business. The cash cycle underneath it is, and when that cycle breaks, the buildings don't save you. So how does an owner protect against that kind of collapse before it happens? This is where bonding comes in, and it's the part of construction economics almost nobody outside the industry has ever heard of. To bid on most large public or commercial contracts, you don't just need the skill to build the thing. You need a surety bond, essentially a guarantee, backed by a bonding company, that if you fail to complete the project, someone else gets paid to finish it. The bond premium itself is usually a small percentage of the contract value. That's not the expensive part. The expensive part is what the surety demands to issue it in the first place. Audited financials, a strong balance sheet, real working capital, and very often a personal guarantee from the owner, putting your own house and savings behind every single project your company takes on. This is the quiet barrier to entry that keeps this industry consolidated at the top. A garage-sized outfit with 2 trucks and a great crew can build almost anything technically. What it usually can't do is get bonded for a $50 million hospital contract, because the surety isn't underwriting your craftsmanship, it's underwriting your balance sheet. Which means the biggest advantage in this business isn't the ability to build well. It's the ability to survive long enough, with a clean enough set of books, that someone else is willing to financially vouch for you before the client will even look at your bid. Here's what the listing doesn't show you when someone brags about landing a huge contract. Winning the bid was the easy part. Getting bonded to be allowed to even submit, it was the actual filter. This is exactly why the very top of this industry looks nothing like the bottom of it. Firms like Turner Construction and Bechtel didn't get to bid on billion-dollar infrastructure and stadium projects because they're better builders than a strong regional contractor. They got there because decades of clean financials and bonding history gave them access to a tier of contracts that a newer company, no matter how skilled, simply cannot get bonded for. Scale in construction isn't really about the size of your crews. It's about the size of the balance sheet a surety is willing to stand behind. Now let's talk about who inside this business actually keeps the healthiest margin, because it isn't who you'd assume. You'd think the general contractor, the name on the sign, the company running the whole job, captures the biggest slice. It doesn't, structurally. General contractors typically run gross margins in the 12 to 16% range. Specialty trade contractors, electricians, plumbers, HVAC installers, often run gross margins of 15 to 25%, and on a net basis they consistently outperform general contractors too, landing somewhere around 7 to 8.5% net compared to the GC's 5 to 6. Why? Licensing. An electrical or plumbing license takes years of testing and apprenticeship to obtain, and that barrier keeps competition thin in a way that open bidding for general contracting simply doesn't. The general contractor is, in a very real sense, running the highest risk, lowest margin seat in the entire project. It carries the bond. It carries the schedule risk. It carries the client relationship and every delay, every change order, every dispute. And then it subcontracts out most of the actual specialized work to the trades who, protected by their licenses, negotiate from a stronger position and keep more of what they earn. Mistake 1 that new contractors make. Assuming the GC role is the top of the food chain because it's the most visible one. Mistake 2. Assuming self-performing more of the work yourself protects your margin, when for many trades it just exposes you to more of the licensing, insurance, and labor risk you were better off subcontracting away. The company with its logo on the site trailer usually isn't the company with the best economics on that site. It's the company absorbing the risk so that everyone underneath it doesn't have to. There's one more cost sitting underneath all of this that rarely makes it into anyone's pitch about owning a construction company. The equipment. Cranes, excavators, dump trucks, scaffolding. None of it is cheap. None of it lasts forever. And almost all of it sits depreciating on your balance sheet, whether it's on a job site earning money or parked in a yard between contracts. Some contractors buy, some lease. Either way, that machinery has to be insured, maintained, and financed regardless of how the current bidding cycle is going, which means your fixed costs keep running even in the months your revenue doesn't. Given everything so far, thin margins, delayed cash, mandatory bonding, subcontractors out earning you, you'd expect this industry to be brutal on new entrants. It is. Construction consistently ranks as one of the industries most likely to fail early, historically losing around 2 out of every 3 new firms before their 5th year, driven overwhelmingly by cash flow problems rather than a lack of actual work. Some of that has improved with better accounting and project management software, narrowing the visibility gap that used to sink otherwise viable companies. But the underlying pattern hasn't changed. A company can be fully booked, genuinely skilled, and still fail, simply because it couldn't see, in real time, whether it was making or losing money on the jobs it had already finished. Here's the part that should actually reframe how you think about this whole industry. If your company survives to year 5, something changes. Survival rates for construction firms that make it past that point climb sharply, up toward the mid-90s% range going forward. Year 5 isn't a milestone. It's a filter. It's the point at which the company has finally built enough of a cash cushion, enough bonding capacity, enough repeat client relationships to stop operating one bad payment cycle away from insolvency. Everything before year 5 is survival. Everything after it is compounding. So who actually profits from a construction company? If it isn't primarily the owners standing on the site in the hard hat, follow the money all the way through and you get a very different picture. The material suppliers get paid first and get paid regardless of whether the project is profitable for the builder. The bonding company gets its premium up front and takes almost none of the downside risk if the balance sheet behind it is strong. The bank financing the early payment gap, the way Carillion's partner banks did, earns its fee whether or not the underlying project ever turns a profit. The specialty subcontractors, protected by licensing, negotiate from the strongest position on site and often walk away with the healthiest margin of anyone involved. And the general contractor, the company that actually assembled the deal, carried the bond, absorbed the schedule risk, and put its name on the building, is left competing for whatever's left after everyone with a stronger negotiating position has already been paid. That's the trapdoor under the hard hat. The romantic version of this business is a builder creating something permanent with their own hands. The real version is a company acting as an unpaid bank for its clients, an unpaid insurer for its subcontractors, and the last person in the payment chain to actually get made whole. So does any of this mean owning a construction company is a bad idea? Not necessarily. It means it's a completely different game than the one most people think they're signing up for. The contractors who actually build durable wealth in this industry aren't the ones who win the biggest, flashiest contract. They're the ones who treat cash flow forecasting with the same seriousness other businesses reserve for their actual product, who negotiate retainage terms as hard as they negotiate price, and who understand that surviving to year 5 is the real achievement, not the ribbon cutting on any single building along the way. The company on the billboard isn't necessarily the company that's winning. The company quietly tracking every dollar of working capital every single week usually is. Now, if thin margins financed by other people's risk sounds familiar, stick around, because there's an industry that runs almost the exact opposite playbook, and it's just as misunderstood. Picture something the size of a small city, floating, fully booked a year in advance, selling every cabin below what it actually costs to sail. That's not a mistake. That's the business model. Next time, we're going to break down the economics of owning a cruise ship and why an industry that deliberately sells its core product at a loss is one of the most profitable things you can own on water.